What is going on, everybody? This is S Trades, and this is day 16 of the bootcamp. And in this video, we're going to be going over SMT divergence. And without further ado, let's get straight into the video. So, what is SMT divergence, right? There's different names for it. There's smart money techniques, smart money traps, smart money trading. You know, there's a lot of different names. Again, ICT just loves kind of putting different labels on different things and making them sound smarter and stuff like that, right? But all it is pretty much a divergence in correlating assets, right? So, as you guys might or might not know, NQ and ES, right, which is Nasdaq and the S&P 500, are correlated assets, right? They're supposed to move the same. They're supposed to move in a very I shouldn't say the same. Instead, they move in a very similar way, right? So like if they're making higher highs and higher lows, both of the assets are going to be making higher highs and higher lows and things like that, right? But sometimes, right, you get this sort of divergence, right? So whenever there is an uptrend, right, for example on Nasdaq, ES should be also in an uptrend, right? It's supposed to both be making higher highs and higher lows, right? And it's, following each other in a similar way, right? And you guys might know, for example, an RSI indicator, right, which is usually like down here, and it kind of shows you a divergence in price and things like that, right? This SMT, in my opinion, is better because it actually shows you a divergence in real, like on a real chart. Like it's not just an indicated divergence. Instead, it's a divergence in the actual price, right? So, all SMT is, right? So, for example, let's say we are making a downtrend on ES and NQ, right? Let's say we're going down, right? Lower lows and lower highs, lower lows and lower highs, right? And you see that the last low created on ES, right? We made a lower low, lower high, and then you see that that low ends up getting taken out, right? Makes like a liquidity sweep and ends up pushing back up higher, and now we're trending back upwards, which is a reversal, right? But you guys might spot it on NQ that low wasn't taken, right, as ES did. So we're making lower lows and lower highs, right, and that previous low was not taken, right, and instead it just kind of pulled back maybe close to it or whatever, and then it started making that reversal. So now we have this SMT divergence between the two correlating assets, right? So ES took that low, NQ didn't, right? So what does that really mean? Like what happens when you see an SMT, right? And a lot of these scenarios, it's most likely indicating a reversal, right? And SMT, in my opinion, isn't really used like an entry model, although you can do it if you're really good. For example, like Powell, I don't think he really enters on SMTs, but it does help, right? If you just identify an SMT and you just kind of enter off of, I don't know what, the way a lot of people, including me, the way we use SMT divergences is incorporating into a model, right? So for example, I have my own strategy, right? The inversions, right? So let's say if I was to enter a trade, if I was looking, let's say, to enter longs, right, and I was anticipating this reversal happening, right, what I would do is I would wait until, let's say, some low gets taken out, and then I start to see that, okay, ES took the low and NQ didn't. This might be a potential SMT, right? The only thing you also got to realize, right, it could be like a temporary one, right? Let's say if ES took that low and NQ is just lagging behind and it still hasn't taken it out, it could be just possible that it just takes it out in a few seconds later. So that's why I don't really like entering just straight up of SMT or you just anticipate it, right? Because the very next candle could just go ahead and take out that low and it'll just get stopped out for no reason. But let's say in here, right, what I would be doing is I end up noticing that, okay, ES took out that low, NQ didn't, and then I end up seeing like some sort of an inversion, right, in this leg, right? And then I see that ES took out that low, so then I'm like, okay, so this could be a potential reversal, right? We could see some sort of reversal at this point because now we have an SMT in play, right? I drew that really badly. I could be realizing, okay, we might have some sort of a reversal thing happening in here because ES took out that low, NQ didn't, right? They're supposed to be correlated, right? But the times when there's like a divergence in between those two correlating assets, that might indicate, okay, smart money is trying to do something here, or maybe price is trying to get like a very aggressive reversal, right? But in the case of like, there's also other questions of like what kind of pair would you trade, right? For me, it doesn't really matter, right? I usually, for like 99% of the time, I trade NQ. So if I notice that ES takes out a low and NQ don't, I'll just, enter it along here, right, on NQ. But what some other people do is they enter on like a weaker or a stronger asset depending on what they're trying to do, right? So for example, for longs, right, you would want to enter on a stronger asset. And what that means is if you're bullish and you're trying to enter some longs, right, what you would do is in this case, this would be a stronger pair, right? Because we did not take out that low, and we're much closer to these internal highs than ES is, right? So what could happen is NQ could go ahead and take out the highs, and ES might take out like one high and doesn't reach the second one because it might be too far. So in this case, for long, you'd want to enter on a stronger pair, right? On a short, however, it would be the opposite. So for shorts, it would be the opposite, right? We're making higher highs, higher lows, higher highs, higher lows, right? And we end up seeing that on ES, right? We made a lower high. However, NQ ends up taking out that high, and then we see an immediate push lower. So now this indicates that we have an SMT in place, right? So in this scenario, you might want to enter on ES because it's closer to the lows, right? But for me, it doesn't really matter because most of the time I just trade NQ. I don't really trade ES at all. So it doesn't matter if, let's say, NQ is a little higher than an ES, I'll still take it, right? And what I will do is instead, for example, let's say we're reaching for this internal low, right? So let's say ES ends up taking out this low, right? And then NQ doesn't, right? So we see that NQ on over here doesn't take out that low and ES does. What I would sometimes do is I would take out my position on NQ, knowing that, okay, ES ends up taking out that low. And now let's say if I'm starting to see some push up higher, right? That might indicate that, okay, now we're reversing, and you also start to see, you know, NQ kind of follow up. So if I see any of this kind of rejection off of an SMT, I'll most likely just take out my full position, because now we might have another SMT in play, right? Which is over here, right? ES ends up taking out the low and NQ doesn't. So I don't want to get trapped in this SMT and then either get break even or, you know, hit stop loss. So that's pretty much how you use the SMTs. And what another thing that is really helpful is, for example, like what kind of SMTs are you really looking at, right? You're looking at SMTs at important highs and lows, like very obvious highs and lows. You're looking at SMTs within like fair value gaps, right? So let's say there's a fair value gap in this leg, right? And then NQ comes and takes out like a little internal low and taps into that fair value gap, and then ES doesn't. That's also very significant. And just, you know, general like very obvious highs and lows, anything 5 minute and above is very major, right? Especially for SMTs, right? I wouldn't really pay attention a lot to like 1 minute SMTs just like within a random range, because that wouldn't really be telling you any stories. It doesn't really matter because, you know, we have these little tiny like divergences in price all the time, like on a 1 minute, right? So you wouldn't be like a crazy man just paying attention to where's ES taking out lows, where's NQ not, you know. You're not really doing that. Instead, you're looking at like a very obvious high, very obvious low, like previous day high, previous week high, previous week's lows, previous session highs and previous session lows, or just like a very obvious internal low that's like very important, right? So that's pretty much what you're paying attention to. So for example, looking over today, right, this is literally today's example, right? What we have on the left is NQ, and what we have on the right is ES, right? So we see that this is Asia high, right? And on both ends, right, at 110, right? Yeah, around 110, ES comes all the way up on top, takes out Asia high, right? And then we look at NQ at 110. We did not take Asia highs, right? Asia highs is all the way over here, although ES already took it, right? So now what we're starting to see is rejection, right? So we can see that, boom, NQ ends up being the lower asset, the weaker asset, right? It hasn't taken out Asia high, although ES did, right? You can just quickly take a look at what do you have in this position. You have this little CISD, right? Let's say you were to enter on the CISD entry, right? Stops at the high. And let's say you were targeting this inefficiency, which is the discounted one. And then boom, you get a quick 1-to-2 ratio, you know, something calm. And you see on ES, it also goes lower, right? So if NQ takes it out, some higher or low, and ES doesn't, that's an SMT, right? And it's pretty much the way I would use it is just like an addition to it, right? You're not necessarily just trading the SMT alone. Instead, what you would be doing, you would be adding that as a good confluence towards your strategy, right? You would never really have SMT hurt you. Like a lot of the strategies nowadays that especially trade ICTs, probably most of them include some sort of an SMT, right? It's not like a mandatory PDA, right? Like, oh, you have to have an SMT, right? Some strategies do that, but it's just like a very good addition for your strategy, right? Let's say for my inversions, just like I said, if I see an SMT, it's a very good confluence. It's a very good addition towards my trade, because now I see that one asset took out a very important high and the other one didn't. So now there's this correlation, and that could help out my trade. Another good example, right? On the left we have NQ, and on the right we have ES, right? We see that there's very important highs, right? Just AM highs over here on both ends, right? So we see that the AM highs get an SMT, right? ES doesn't end up taking it, and then boom, we see a dump right after that, right? You could have got like a little inversion entry in here, right? We had like a 3-minute, I believe. We could have taken that, right? And we see that boom, and right after the SMT gets put in place, we just dump and continue the move lower, right? So it's very helpful to use them. They're always there. They always occur, right? Again, but on very obvious highs and lows. It's not just like a random high or low, right? You don't want to do that because it wouldn't really make sense. So we have this pre-market high that got put in place because of news, right? And what happens, we have this high on NQ. NQ ends up coming up all the way higher and taking out that high, while ES never comes even closer to it, right? So boom, we get an SMT, right? Let's say in this scenario, you could have entered on this 5-minute inversion, right here. Boom, you get that inversion. I'm just giving you guys a scenario, right? It's not like my whole entire strategy, but just, you know, an example for you guys to look at, right? And let's say you're targeting this internal low. So what happens in, again, like I said earlier, you could target those SMTs as also as take profit, right? So for example, let's say you entered on ES, right? So let's say you end up taking that on ES over here, right? Boom, you take out that short because you saw that there's an SMT and it's closer to the internal, right? But what you see is happening, NQ ends up coming down lower, taking out all of these lows, right? We end up taking out this low and this internal low. It gets taken out, and then immediately start to see a reaction back up higher. And on ES, you don't take it out, right? So in this scenario, right, you could have simply taken out your full entire position once NQ took out that low, right? You see that NQ took out that low, ES didn't, and you start to see some kind of a displacement back up higher. In that case, I would just take out my position because we have an SMT that could potentially send us all the way back up higher for a reversal, right? In this case, we don't go all the way back up higher, but I wouldn't see a reason why people would just, you know, sit through this, you know, after the SMT gets put in place. A lot of people would be not so confident holding that trade because this SMT could act as a full-on reversal, and, you know, you would be kind of risking your whole entire position because you're already so much in profit, so you might as well just take what you got, right? And one more example, right, that I'll show you with a fair value gap, right? This also could help with fair value gaps, right? So what do we have here on the same exact example, right? We have this 5-minute over here that gets tapped on NQ, right? But then you start to look at ES, right? You see on this, it doesn't get tapped, right? So boom, you see that on NQ ends up getting tapped, and on ES it doesn't. That could also just act as a very good PD rate for you, right? If you were looking for some entry once price taps in that fair value gap, and you see that NQ ends up going in there and tapping that fair value gap, and ES doesn't, that could still act as a play because NQ already tapped it, and ES doesn't really have to tap it. Or of course, it'll be better if it does. But if you see that the price ends up tapping that fair value gap and start to see an immediate reaction with a lot of displacement, then most likely it will just act like that, and ES doesn't really need to go back up higher and tap into that fair value gap also. So that's pretty much it for this video, right? It's pretty simple concept to understand, right? It's a very good, and I want to say an indicator, but it's a really good additional PDA that you could add to your strategy just to help you out and add extra confluences towards your trades, right? I don't trade them as an entry model, but instead I just have that as a confluence, right? So that's about it for this video, guys. If you have any questions, if you guys don't understand anything in this video, please comment down below, like this video, and I will see you guys in the next video.